So now headed into the next panel session, it's going to be led by our own Neil Munroe, Deputy MD of BIIA. The topic is the changing dynamic of risk management information. On stage with Neil, we have Edoardo Borsari. He's the International Market Director at CRIF, and Mohan JAYARAMAN, who is the Regional Managing Director in Asia for Decision Analytics and Business Information Services at Experian, and Marc Barrachin, who is the Managing Director of Product Research and Innovation at S&P Global Market Intelligence. Gentlemen, over to you.
Thank you.
Thank you very much, Marc. Welcome back. I hope you had a good lunch. Probably had too good a lunch. So my top tip to keep you awake this afternoon is not just drinking coffee, is try one of these sweets. Because I've just taken one and it's actually killing me. They are very strong cough sweets. I didn't realize that. I thought it'd be something nice and fruity. So if I start coughing, it's because I've got a cough sweet in my mouth. So you can follow the logic on that one later. We're going to try and make this sort of upbeat because we know that you'll all be, as I say, struggling with too much food. Good food. And I do hope you enjoyed lunch. It's one of the best restaurants, I think, in Bangkok. When we sort of were putting this agenda together, we came up, obviously, with our strapline, data analytics and AI equals the future of risk management. And so we're, I suppose, if you look at that equation, coming back from the AI perspective into the data realms. And so that's what we want to talk about very much in the next hour and a half. What we're going to do is, as Marc's introduced, we've got a great panel of people, of experienced individuals here in this whole area of risk management. We're going to cover both the consumer and business information side and looking at, what the changing dynamics are. Those changing dynamics, if you've read the sort of little write-up we put on the website, is all around, the changing dynamics in terms of digitization, improving data. There's regulatory activity, increasing access to data. There's also regulatory activity which is restricting data, so we've got those conflicts around. And then there's obviously quite a lot of differences between consumer and business data that's available as well. So there's a huge amount of topics we're going to try and cover through in an hour and a half. I'm not sure we'll get through all of them. But the guys here are going to really just kick off with a brief presentation from them as to what their view is around this whole subject. What are the changing dynamics? What are the key drivers that they see going on in their respective worlds? And very much I've asked them also to look at it not just from an industry perspective, but to, they're working day in, day out with customers as well, customers of all of you. So what are they seeing from the customer side? So I'm hoping you'll get, and over the next sort of 10, 15 minutes from each of them, a good understanding of where their view is. And then I'm going to pick up some of their threads and some of their comments. And I know that some of them will be juxtapositioning in terms of they won't necessarily agree with everything. They're all friends, trust me. But we're going to have a good, healthy debate, I think, and that's great. But I really, really do want to encourage a lot of input from all of you as well. So we're going to go through probably about the first sort of hour, just setting the scene, having a little debate up here. And I really want to push it out there and get as much feedback from yourselves and questions, because it will be really a great opportunity to take this expertise that we've got on stage and drill down with them as to what their views are around this very important topic of this changing dynamics around the data. And data, as we know and already talked about, is changing immensely. So, no more ado. First up, Edoardo, over to you. If you'd like to just tell us a little bit your perspective, the changing dynamics, that would be great.
Absolutely. Thanks, Neil, and welcome to everyone back from the audience. I think that there should be a clicker here.
Yeah.
So we put together a brief presentation just to stimulate the discussion after that. And of course, in the last few years, we've been experiencing a true transformation, really driven by a regulatory change, new rules, a new set of data, new technology, and really big change in the behaviors of our client and our clients' clients. What does this mean in the risk management information business? Of course, we have big change in the regulatory, like different way of open banking frameworks. Of course, in Europe, we have GDPR and PSD2, just to name a few. We have a large usage of complex API ecosystem that now finds new application every day. Of course, 5G is coming, again, just to name a few of the technology that are disrupting the risk management area as well. In terms of new set of data, there are access to account, alternative data, or mobile data, just to name some of the most important ones. And of course, in the digital transformation, the behavior of every one of us as clients, of course, is changing. And there are concerns and there are different ways of managing or really not managing our privacy data. So when we think about risk management, the risk executive must keep up with the pace of the new dynamic environment. What does it mean? Of course, there are two big groups of, let's say, different reactions. There are the ones that are really focused on the concerns. Everything is changing. Everything is not manageable as before. And maybe you are thinking, Marc was mentioning this morning, the threats that technology will drive to cut many jobs. And maybe there are long-term implications to the current trade war across nations. And maybe from trade war, we can really jump on a tech war to try to control the innovation that every country sees strategic for the business development in the future. And all these factors together maybe are just the tip of an imminent, let's say, financial crisis. Just to name some of the many potential concerns that during a transformation you might look at. Of course, there is also the opposite side, the one that are more optimistic, the one that sees in the balance more opportunities that concern to deal with. Now there is really a shift between, let's say, a bank-centric environment to a true customer-centered environment. There are a lot of new business models really based on complex ecosystem and competition where we need to understand how to work with what used to be our competitors. And now there is a different way of approaching our clients, maybe together. And of course, we talk a lot this morning how to optimize and use in a smart way the new technology, the new artificial intelligence, machine learning, and the other type of technology that are now available for new applications. This is more or less, of course, the scenario that we see. Today, I would like to share very, very high level a couple of numbers and example of concrete application where the new technology, new framework, and the new way of approaching our clients can be successful for lenders in general. We choose an example that we've been working on in Europe under the umbrella of the open banking. Following the structure, you see that here we have a true transformation. There is new regulatory driven by the PSD2. There are new technology applied, meaning thanks to an ecosystem of the API, we are capable of collecting account, checking and saving accounts data from different institutions in order to use for risk management purpose. And based on this, we can develop, let's say, a new solution that I'm going to briefly touch. And of course, there is a shift really in the approach. Before, the client used to knock at the door of the bank, stay in a long queue and waiting for the turn. Now with this kind of approach, they are really becoming the center of the system where they are more in control of the data and the solutions that can be offered to them. So two concrete applications related to open banking for us, for a data-driven company as CRIF. What we did was to try to combine the traditional data, the credit bureau data, the credit bureau score, and all the other, let's say, traditional data, together with the information that now are available about, let's say, the account and the payment data. And what we did was, of course, to use this kind of integration driven by APIs. So every time a consumer gets the consent, now we can gather all information about their accounts from different institutions, collect this large amount of data, relatively messy, try to analyze, crunch with a system based on machine learning, and try to categorize and try to look for patterns that then can be used with the traditional data. So the goal here is through this, let's say, what we call categorizator, to develop KPIs that can be used. In the first goal, to try to improve the creditworthiness assessment that our traditional client does. And the result is improving the quality of our tools, meaning improving, for example, measured through the Gini index, and at the same time improving the capability of score the so-called unscorable. Every time you have a situation where you don't have traditional data, what do you do? With this kind of approach, of course, we can solve these two problems together. As I said, a couple of results. What we are currently doing is, with our current clients, we approach them with proof of concept. We ask them to provide information to us. In this situation, we have a mid-sized bank in Italy. They provided us 1.3 million of transactions. We put together, as I mentioned before, and we combine with traditional data. The result were, in terms of Gini index, the idea is, if we start from consumer, we see that I'm just taking the first row. When the consumer provide access to all their banking accounts, that is the way to read the slide, all main and not main. It means all access to all the banking accounts, only their main account or the secondary account. But you can see that, generally speaking, the Gini index increase dramatically every time we combine traditional and I call the new data because are now available. Of course, we are talking about account and payment data in this situation. And the situation is even better when we focus on the small business on the bottom, where the improve in combining the two words is 17 point based on the Gini index. The second part, as I was mentioning, so this is, we have better tools to evaluate the creditworthiness assessment. But at the same time, we also have a tool that helps us increasing, let's say, the scorability or the opportunity to have, let's say, an indication where traditional data are lacking. And in this case, of course, because we are getting the information from the accounts, even if this information is coming from another bank. So maybe I'm a prospective bank looking to my clients. I don't have any information on these clients. But because of this kind of open banking approach, I can get information on the accounts from another institutions, even if without having credit bureau data. And in this situation, of course, we are capable of offer an indicator of risk. So this is from the point of view of the tools. Then the second step was, okay, let's try to perform and apply this kind of, let's say, solutions to a portfolio of applications. So we ask to our clients to provide more than 40,000 applications where we run first their current policy, and the result were 70% of that application were accepted and 30% were rejected. And then, of course, we apply with blending traditional data and the access to account data, and we were able to swap in to the accept 88% of the previously rejected, and we were able to select and swap out from the previously accepted 8% of the population. Doing this, the balance of the theoretical portfolio using this kind of approach would have been 90% accepted and 10% rejected. I forgot to mention probably the most important things. The key requirement was to keep the level of the risk of this portfolio at the same level. So the bad rate has to stay below 3% as the original bad rate of that portfolio. So these are the strong results that, again, combining open data with traditional data, we are capable to prove that it works in a concrete application. The second one is not really focused on the creditworthiness evaluation, but is more focused on, let's say, the business development, the opportunity to provide insight, custom insight, using the same logic, gathering all the information about the account, studying the pattern of, let's say, the purchase and all the other activity that we are currently doing, creating the right attributes based on the portfolio of our clients in order to profile and try to find the best way to match the product that the client, of course, wants to offer with the needs that the clients of our clients has. And that is the key. So try to find the best way. In the old, let's say, world, everything was driven by marketing campaign. Now the goal is to try to have not the same campaign apply to, let's say, a group of target people, but try to have more custom solutions that can be focused on myself based on the behavior of my, let's say, expense. And the idea is exactly to try to find the best product that I need, when I need, at the price that I can afford. And this is just, from our point, a starting point of something that we foresee will evolve during, let's say, the next month and a few years as well. What is the next step? So here we saw a concrete application in, let's say, the risk management and the business development, but to some extent is still a closed environment, meaning we are adding to the traditional data the access to account data. So it's still all in the bank and in the lender space. The natural evolution is to apply the same model into a more, let's say, integrated ecosystem where we can open to other, let's say, vertical markets. We were talking about insurance, telco, other kind of industry that as soon as we can open this and approach with the same solution but gathering also that kind of data, then the offering that we can, let's say, suggest to our client is much bigger. And we can really start driving triggers based on their real needs. So maybe you are at a branch or you are with your phone on your, let's say, banking account, and because of this kind of integrations, maybe you have some inside useful information about a potential insurance that you have, or maybe you can recheck a better plan for your phone. Experience like this. So this is where we are really looking for. We are building the foundation, working with banks and lenders, doing proof of concept on their data to prove that this is a concrete application that works. And the next step is start opening to other players to expand the usage, specifically, of course, on what I call the business development or marketing, meaning generating triggers that are useful for the final clients based on what they need at that time. So this is, sorry, I pushed the wrong button. This is just a few slides. Again, I hope that can stimulate some thoughts and maybe questions that we can articulate with the other members of the panel during our session. Thank you very much.
Thank you. Thank you, Edoardo. I think that's very useful, and I think I've got a few questions about the repositioning that all this tends to do around sort of credit bureaus in their old-fashioned way and what they then become in terms of actually determining the future of consumers and transactions. I've always had an issue about how that lies with the people that you get most of the revenue from, which is banks and others. And I think we're going to have a good debate about that one. But we'll park that for now. Thank you very much. Mohan, do you want to just share with the audience your perspective, if you don't mind? Thank you.
Very good afternoon. I actually think, everything that Neil said earlier, there are more points of agreement on the retail side with what Edoardo said and what I will possibly walk through. What we have tried to do over the next few slides is give you a quick view of the way we've seen the evolution, specifically in the APAC world. And I thought Neil sort of said it well when he said, what's the evolution of the credit bureaus into this whole alternate data world? And that's broadly what we've tried to cover over the next few slides. Let's go through them. And as I said, I think the position is similar, to leave a few thoughts with you and to see if we can pick them up in a series of questions later. I thought I'll start with a quick introduction to Experian. So we are a data analytics decisioning organization globally. We run operations in about 37 odd countries with bureaus that we run in about 20 of them. And one of the things that's actually been fascinating for us is to look at the way information is evolving and the role that bureaus will play in these 20 countries, and plus the newer countries where we see data coming to the fore. So the broad theme was to tie this in with everything that we are doing and maybe talk to you about the work that we are doing in innovation and in trying to bring together a lot of the work that we're doing with data, alternate data, and with new techniques, and to put them to practical use. cost of stating a few of the obvious things and getting them out of the way, the first thing that's happening in the world around us is computational capabilities have grown exponentially as has storage costs come down, as have storage costs come down exponentially. I remember, a point lost in history when I passed out of college. I was fairly interested in artificial intelligence, and we had a lot of discussions internally at that time on the theme of AI and what it could do and what it could not do. And I remember this famous conversation that we had between a few of our friends at that time. We concluded broadly that given the capabilities on computing that we had in place at that time, remember this was the 70s, that we couldn't, bring ourselves to the level of practical usage of AI in the way AI could be applied in the real world. Cut over to the 90s, this problem seemed a little more, tackleable, if I can put it that way. Cut over to now, a couple of decades from then, suddenly the cost of computing has gone down so dramatically, and the cost of storage has gone down as well so dramatically, that the ability to put both of these together and to handle this exponential amount of data is becoming a much easier thing to do. Add that with the whole theme of open data that Edoardo talked about, the predominant overwhelming concern for most of the regulators globally seems to be to make sure that the information that we have of consumers being harnessed the right way and put together in models based on consumer consent that can be used for their welfare. And that's the theme that we see rolling out within APAC as well. We see this as one of the dominant forces and something that will grow the increasing stockpile of data that's already growing as we speak, and is going to be a big force of change in this whole theme of data availability. If we put both of these themes together, the fact that computing is cheaper, data storage is becoming even cheaper, the fact that data is growing exponentially, brings us to the way we would think about this in the APAC context. The theme for APAC, as we've sort of pointed out repeatedly, is the fact that paradoxically, 60% of the world's population lives here, and about 40% of these people are credit included. So a 3 billion odd population is basically non-included into formal credit as we speak. But on balance, the big advantage with this population is that they have access to telecom products, payment wallets that they are using in proliferation. And if you put both of these together and put the transaction information that's coming together with perhaps also the banking information that we can bring to the fore, we're sitting on what we think is a huge opportunity to extend credit or use all of this information in the extending of credit to this base. And we believe in that context, this whole alternate data in the APAC context is data. Let's then bring this together in the looking at data and make this base statement in the fact that all data is not born equal. If we go out and look at all the information that's available and sort of look at it in terms of the lift it can bring, we'll find that it sort of maps in terms of access and in terms of the lift it can bring in different quadrants. So for example, as we have looked at it, there are things like, for example, mobile device data, which is basically the things that you might put on the mobile device of a consumer that can give you, say, privacy-linked things like, say, location and so on, to telco data, which is basically payment information or transaction information of consumers with telcos, utility data, and so on and so forth. And what you'll find is that there's a spectrum of results that you'll get out of using all of this data, which spans from, let's say, a low increase in Ginies that Edoardo referred to, between the 0 to 20%, going up in some cases to as much as about 40%. And what we think this makes possible suddenly is the way of looking at this information as a surrogate for credit bureau data that we traditionally used. So think of this in two ways. In the developed world, this is something that will add on to the existing set of data elements that we already use and give you a lift in Ginies. In the developing world, the APAC countries and parts of the world that are still credit unincluded, this is a means by which you will be actually able to get people into credit inclusion and be able to harness this data for something that might actually be of value to these individuals in getting into financial inclusion. Taking this further, the key, as we see over the next few years, is going to be the whole theme of making sure that we are able to harness this information that's coming out and putting it to use in managing retail risk. And this is going to be the dominant force of what we think will determine what will be a good credit risk management practice versus a not so good credit risk management practice. And the way to, again, think about this is not to think about this as just one data block. So, for example, it's not just one bureau information block or a banking information block along with a telco information block that's separate. But the layering of this data, one on top of the other, and the way we can actually get them to come together and talk about that sort of customer 360-degree view that we can put together to give us that view of what the consumer might score into, that we think is hugely promising as an approach to retail risk management in general. What I wanted to take a quick segue into is now to talk about the fact that we've talked about data till now. We've talked about the fact that there's a lot of data that's coming through. Not all data is the same, and there's means by which we can use this information to score consumers. But what I think is also becoming increasingly apparent to us is the fact that this data cannot be normally harnessed. So let me explain that a little more clearly. In the old world, what we do with data is build static models with them, the regression models or the rule-based models that was referred to in the morning. What we think is increasingly becoming apparent is the way we will be able to use some of this information, just given the size of these data blocks and the flow of this information, is defining variables almost on the fly that we'll have to build and make a part of our overall risk models. So for instance, if we bring this into the telco world, we today take about 1,500 odd variables and make them flow variables that we think will be more predictive of consumer risk. Now, these variables couldn't be computed not in real time and not in a time frame that made them economically feasible to use in the past. But now what we can do is to compute these variables on the fly, put them together in a model that can actually make sense, and construct these models to talk about retail risk in ways and forms that we couldn't think about in the past. What we are realizing is it's not as much, as Dr. Anthony mentioned in the morning, about the techniques, as much as the fact that we need to answer a question on what we think is a good credit differentiator. And there is means of doing that with this information using many of these techniques or the spectrum of techniques that we can talk about. And that's the sort of practical use that we need to bring to this whole frontier. So if we put this together, think about the fact that there is data. Now what we are talking about is the fact that there are definitions of flow variables that we can define, which we'll have to put together into models that we think will be usable. There's another frontier that we can take this into, which is basically the whole theme of networks. As consumers and businesses are getting connected, one of our other realizations is that trying to predict the performance of individuals versus looking at their networks, there's a lot more of information that comes through if you start looking at their network rather than just the individual. So for example, in the bureau that we run in Singapore, one of the things that we did is to start looking at an SME score that we tried to put together with a network analysis. And what we found is that the lift that we got over traditional models was over 20%. And in Edoardo's language, if we look at the swap-in, swap-outs, if we look at the number of consumers that we were not able to score earlier, that we were able to score now as a consequence of the fact that we had information about people that they were linked to, that we had information about, and we could bring that into a score. That was almost in the range of something like about 12% of customers that got incrementally scored. If you put this together, the additional advantage that you see is just the fact that you can now start taking decisions on the basis of information that's extendable through the network. And both of these as techniques are almost as valuable as the core data itself. So the thought that I wanted to leave with all of you is, exciting world that we are heading into with all the data that's coming together. And the fact that, for example, it's not just the data, but the kind of data that we are using that's going to be exceptionally important. The next thing that I also wanted to leave with you is, in many of these techniques, there's an apparent, obvious way of using these techniques and capabilities to actually create models that might give you more information than the base data themselves. Like, for instance, we talked about the whole theme of how flow variables can actually add a lot more value, or similarly, network analysis can add a lot more of value. So as we look at it, bringing all of this together, the key thought that I'd want to leave with you is a hugely exciting world that we are heading into, and one that we believe is going to be hugely transformational in the space of everything that we are doing on risk management in general. But maybe the thing to think about is that this is not just about sourcing the right customers, but also looking at them through their life cycle. What's the best way in which you can actually think about managing limits on these customers, managing them through the customer life cycle? What's the way in which you can harness some of this information in collections and moving consumers more towards digital habits? Is there a way in which you can actually create a virtuous cycle of driving consumer behavior that's a little more digital and help this information in getting that virtuous cycle going? The last thought on this is also the fact that with all of this coming together, there is this whole proliferation of risk and ID issues that we need to address, and we believe that this information implicitly gives you the ability to be able to do that. Maybe the thing that we need to think about in balance, as we've talked about all of this, and a useful subject to the debate and discussion going forward is obviously the privacy concerns and the means by which we can actually get some standards to be put in place that can make these practices friendly to the consumers on one side, while at the same time making sure that this information is getting used appropriately and without transgressing some lines on privacy that we might want to walk over. So with these thoughts, I'll pass back to the panel and look forward to questions later.
Thank you, Mohan. I think it's going to be very interesting, and certainly, yes, when both of you, when you were talking around this sort of, there's all this data flowing around, but what transparency is there and what consent is there and all the rest of it. Regulation is my background. I don't want to get too much into that, but I think it's as we even talked about this morning, it's a key area. These two guys are consumer, SME based. Marc's a self-confessed non-consumer phobe, I think, aren't you? So,
yeah, absolutely. Scares me.
Marc is very good in in juxtapositioning the dynamics here around the business side. So, Marc, over to you.
So, I will start with, when one of my previous jobs, my boss tried to insult me a few years ago, calling me a data geek. I am proud to be a data geek. I've been a data geek my entire life. My life is data. Back in the 90s, everybody said, what do you do? I'm like, in my financial information data. They're like, what is this? I'm the coolest guy in town now. So if you like data, you're cool. Just FYI, I am not part of the ratings business. I'm part of the data and analytic business of S&P. Although we do work with the ratings business, our focus is not just a rated universe. So I created this slide, which probably offends a whole bunch of people and probably raises a whole lot of questions, but bear with me for a second. SME, commercial, what the heck does that actually mean? And by the way, it completely varies in every region across the world. And I've had to deal with this over the last couple of years, even internally, saying what is an SME and what do your customers care about? So I've really broken this down into, you obviously have your large public companies, you have your private companies that have public debt, pretty well known, pretty well modeled, lots of data, reasonably okay. Then you start with the consumer side. Well, there's a lot of information. As you heard, there's actually more and more information. And that ties into that small, sold props, sold small part of the market. I just find there's that enormous forgotten middle somewhere. It's companies that are trying to get $1 million loan, they can't. You have a large corporate that does business across the globe. They have no information on how to make decisions to critical vendors without spending an enormous amount of time doing it. So, you might disagree. I just think Western Europe is somewhat better behaved. The U.S. for, a very large developed economy is somewhat backwards, there is no information whatsoever, or whatever is there is typically not necessarily trustworthy, but it's better than nothing. So that's just to set up the stage. So why what's the challenge? Different vendors have 320 million or 400 million or 200 million companies. So don't know what the number is, but it's hundreds of millions of companies. You're trying to serve different people, trying to do different things with the same answer. Doesn't necessarily work. And then you have alternative data that comes back into play. I think Anthony made it. I don't use the V's. I use data availability, timeliness, and quality. If I think about most of it, the data typically is not available. When it is, it's typically, if you're looking for financials, it could be in France 21 months late. Not particularly helpful if you're trying to make a decision right away. And the quality, different parts of the world, not to say which countries. I've had clients say, yeah, I get the financials, I don't trust them. Okay, well, that's helpful. And then the use cases also vary, right? If you're trying to look at supply chain, we do work with large corporates. They have a global supply chain. Automatically, you're talking about emerging markets, frontier markets, developed markets, companies all the way down to sole props. Much different problem than trying to satisfy a regional bank in the Southeast United States that really cares about the Southeast United States and really deep region data sets. And then you have the private equity. Let's not forget, venture capital, there's all this amazing syndication of SME loans and investors trying to invest in that sort of middle. They're really looking for mid-growth. They're looking for target companies. They're looking for corporate development. How do you do valuation if you have no data? How do you know what the companies are really worth? So all of that, I think, is just really setting up the stage for there is no single answer to all these problems. You have to really be very specific. Which then, again, this is my personal view. This is not this one of S&P, I think. If I look at traditional data and models, alternative data and models, there's pros and cons between all of them. Traditional data, well understood, it's global, therefore you understand the models. On the other hand, you got low coverage. If you're trying to do global data set, it's incredibly fragmented. And the models, well, they are what they are with the data you have, right? Forget that they're regression or whatever model. It's just they're what they are. On the other hand, there's the amazing promise of alternative data. Everything it can do for you. Coverage, timeliness, scope, we kind of cover everything. And the models obviously have better Gini coefficient because who's going to show up with a bad coefficient? Because at that point, the model doesn't work. I'm a data guy, which means alternative data has less history. Traditional data modelers will say, do we have 30 years of history? Like, no, I do not have digital footprint of that company for, well, actually 18 months. So you have limited history. There's no entity resolution. So we've done some work around e-commerce transactions thinking, wow, there's probably some signal there. Well, the problem is it's at the point of sale. It's not even at the company. It's not at the parent company. It's at that particular address and location. It requires a lot of manipulation. How does one company call itself versus another? It sounds really trivial, but it's data manipulation, and it's really challenging. It does require new models, and then I did not put it on the slide, but we've had the experience of putting some sort of more advanced financial engineers that are looking across different modeling type, and you put them next to the good old statistical regression MATLAB folks, and you say, go talk to each other. They can't talk to each other. They don't know what each other are talking about. It's a little bit of a problem. And obviously, because they're all better than each other, because that's what they do, if you put quants together, they're all going to tell you they're better than the other. At the same time, we've talked about transparency, scrutiny, and privacy. So that's just my view. So I'll give you 3 examples of where we think things can help. You can start processing unstructured documents. So this is actual work. This is live project. You're going from a unstructured document. In this case, it's Chinese company announcements. You then structure it, and then you start modeling the sentiment. This is data that's been available. It just hasn't been used that way. Why? Because that document on the left, if I'm an analyst and I've got 20 companies that I'm reviewing, That means that every day I have to read 130 pages of this. Now, I don't know you, but after page number 2, my eyes start glazing over, so I don't know about page 130. So we're not saying here that you're going to make an automatic decision based upon this. Well, now there's a tool, or there's a set of tools, because it's a set of different techniques, that then allow you to, one, be able to extract the text that you're looking for, and then eventually sentiment. Now this looks great, but by the way, that model was very, very specifically designed for financial health of the company. And when we started working with the labelers and we're starting to really train the model, this was all very specific to how we looked at the company's risk. This wasn't, oh, the CEO went on vacation at XYZ. This wasn't, the company did this business deal. Is it good or bad? Don't know. Right? So there's not just positive, negative. There's also no sentiment, and it's indifferent. So now you can go through a lot of pages, and as step number 2 highlights, I can start skim reading. I can every morning show up and know exactly what I care about. In this case, it's all in Chinese, but I can use Google Translate. It gets me close enough. And then from a use case, a lot of our customers have said, you know what, I don't care if it's a little bit positive. I don't care if it's a little bit negative. I care about something that's a big change. So that's how that's being used. So techniques, kind of come into play. Not dissimilar, you can start from this time table. In the previous example, we got rid of tables. We took the text. We created sentiment. Here we're doing something a little bit different. We're actually taking documents, again, OCR. It doesn't quite come across on the screen. One of those documents is literally unreadable. You have to actually enhance the picture. Some of the documents are waterlogged. And by the way, you can't read it, but it's 5 different languages on the slide. You can go from that. You can extract the table. You can map it to standard financials, and you can run your standard credit models. That's what's on the right. Last example, if you have that data and there's voice, in this case, this is obviously a much more well-behaved data set. We did the work on earnings transfer, but we're working on applying it to others. If you actually have voice, you can translate that voice into some document. You can extract then sentiment on the back of it, whether it's sentiment, the level of the sentiment, whether it's the behavior and the complexity of the language. You can then start adding that layer of information that you may not have had before. And to us, that's what alternative data is. It's just alternative to us. It just doesn't mean that, it just means we never used it before, right? Social media data has been around for a while. A lot of consumer data has been around for a while. A lot of banking data has been around for a while. Maybe it hasn't been used that way. So that's how we think about alternative data. So those are 3 examples. And just to make it short, so just new approaches, really helpful. They don't answer everything. This is not magical. It does. Every approach takes a lot of work. One thing that's not on the slide, which has come up quite a bit, is the convergence of risk practitioners. So when you think about risk, historically it has been market risk sits on one side, credit risk sits in their little box, operational risk sits, well, potentially in many different boxes depending on the organization. All of that's coming together, right? And I think somebody mentioned it earlier this morning. So if you think about credit, there's actually what we found is an enormous amount of data in KYC, ML that sits there. That's not used for credit, but it sits there and it's compliance, yes or no. Does this company do this? Yes. Okay. How does that change over time? So I think that's something that we'll see evolve as well. And I think it's an evolution. I don't think it's a revolution. There's nothing magic. And it's still all about the details.
Thank you, Marc. Okay. So I may have this wrong, but my perspective there is it's not necessarily about new data. It's about mining and using better the data you've got. Is that right?
Well, it's that, and it's also where else is there data that could be helpful.
Right.
But data is generated. We're not generating new data to do this. It sits out there somewhere.
Good. Yeah. No, I agree. I think that's a very good point. We're just finding it. It's already there. We're just getting better access to it, which is what it's all about in that sense. Good. Okay. I mean, let me just and I've got a consumer and business aspects here. So forgive me if I go down one route and exclude one of you or whatever. But obviously, all this new data that's coming along it seemed to have benefit, but obviously, I mean, things like PSD2 and all the rest of it has a very strict sort of consumer consent on it, doesn't it? So I think that's important to note. How much is the consumer driving this, or how much is it lenders? I mean, and so I'm specifically looking at you two guys first, but you know, this is the thing. I mean, the question is, it's always said, oh, you know, it's consumer needs this, consumer needs that, and are you focusing more, therefore, on them as the end customer, or are you focusing on the bank as your customer? Where are you guys going? Because I got a view, but I'm not going to say it. So, where you want to kick off?
To start, I'm happy to give it a go. So, the way we think about this is, Neil, if you take a step back, and that's why I said I wanted to bring the APAC context in, and perhaps think about this in the context of the people globally who are financially unincluded. I think the world is existing in two blocks right now, and there are a set of people, all of us here presumably, who are credit included, who don't see the challenges on the other side. For us, privacy concerns rule supreme, and they need to. You know, we are worried about making sure that our consented data is used the right way. But for these set of people who are here, and they're not a negligible number. I mean, we see a couple of billion people there. For them, the challenge is currently just making sure that this information is used the right way to get access to credit. So, you know, I point out that you know, consent in that sense works at two levels. One for the set of people who are already financially included, and one for those who aren't. I mean, we see this as a theme playing out even within our region, where we see the regulators take a slightly different view, where they have a financial inclusion imperative. To your broader question on whom we are working with, I mean, what we are doing, for example, in the developed world, where it's possibly more people who are in the former space that I talked about, which is who are already credit included. We're working with them with products that might actually get their consent, and then use the information that they're consenting to add, you know, to the scores. So, for example, say products like Experian Boost globally are basically consumer consented data, but they let you add to your scores on the basis of the consent that you're getting in. For the population on the right, the unincluded population, I think the approach there will have to be something where we will have to take a view on what is a base minimum that we need to get to before we think they are credit educated enough to be able to take a view on consent. So I would think that's the play we see, you know, sort of playing out overall across both of these population masses.
Okay, Edoardo?
Well, from our point of view, Neil, the quick answer is we focus on both. Of course, we develop, let's say, what we call personal solutions to try to offer solutions to consumers. But our core business, of course, is still to focus on banks and financial institutions, for sure. In terms of the case that we presented, the open banking, let's say that convincing banks was the easy part because everything was driven by the regulatory. So, of course, unfortunately for them, they were first to open their data. And so the real issue is to being able to convince consumer to provide their consent because there is value for them. We briefly touched this point this morning. So that's looks like a small, but is a very critical component, because if they don't understand that providing access to their, let's say, account data, they might have some better solutions offered to them, is the key. So that's definitely something that only the experience in the next 6-12 months will really drive how this can be quickly developed, or if we need to spend more time really working also on the, let's say, awareness, how we need to support consumer understanding that this is really a win-win situation. So if they will provide, let's say, the consent, they will have a better evaluation or hopefully a better solution that can ask to different lenders. That's definitely the key for us. So it's a combination. Of course, the shift is, first we were thinking about our clients and their needs. Now in this digital world, we really need to think to the clients of our clients' needs if we want to help our clients be successful. And that is the kind of why the quick answer is we need to take care of both in order to have a solution that is going really to be used by our clients.
It's always a fascinating one for me as to how far you step into that regime in terms of dealing with the client's clients, because then you almost become a broker in my old parlance as well, but it is a relevant point. Mark, do you see this financial inclusion thing in SME as you were, Mark? I mean, do you see the SMEs driving that? I mean, we know there's lots of bodies like the SME Finance Forum, Mr. Gamser, I gave you a plug, and all those type of organizations, you know, pushing this type of thing. I mean, are they driving it? Is there a sort of SME drive? Or are they too busy?
I guess I'm maybe more sarcastic or pragmatic with this. There are bodies, you know, trying to push for financial inclusion for sure. However, what I tend to see is the banks or the insurance companies figuring out how to be more efficient, making more money. Right? So there is the financial inclusion component to that, but before it was never economic to do it. The question is, can new data and new technology make it cost effective? But part of that, I mean, I look at it from, I guess, mostly the U.S. standpoint, and I apologize for that. A lot of it is really that efficiency. How do we do this more efficiently? And I think that there's a difference between financial inclusion of, you know, sort of sole proprietorship somewhere far away, as opposed to how do I make my processes more efficient for a company that comes in and wants a $5 million loan. That's got a 45-day process. I've got to have a high-paid relationship manager, go through the documentation, enter the documentation, go through the credit committee and all that, right? And if I can do this, that's I think we found the banks, at least commercial banks, really focused on doing that because that's where they make their money. So it really depends, but there's a little bit of that, of financial inclusion. I mean, obviously in Europe, you see the Capital Markets Union, and there is something around small and medium enterprise and access to more capital.
Yeah, well, they're certainly pushing that in a big way. Thank you. That's very helpful. So this topic around big data, I mean, this is, we talked about that a bit this morning, and I think it's been very interesting here to really understand, and I mean, some of you touched on sort of the big data, new data, alternative data. Let me just look at it from another perspective. These organizations that are around the current market players, you know, we might call them fintechs and whatever, that are coming up with all this new data. I mean, are they making a difference? And if Enrico, your colleague, was here, the first thing he would say to me is that credit reference agencies are fintech. So tell him I recognize that when you see him next. But I mean, you know, I want to go down this route because, you know, this new data is associated with fintechs, you know, and associated with them using new technology. You know, and I want to really try. Are they making a difference? Are you working with them? Are you, you know, what's happening in terms of, you know, you deal with customers day in, day out. Are they being treated seriously? Are they disrupting? You know, where are you? I mean, and I'd like to understand it from both the business and the consumer perspective, because a lot of hype around it, and part of this conference is all about trying to break that hype down. Is it myth or reality? And you know, you guys are doing a lot of good work and alongside it, but are they making a difference? Are you going to work with them? Are they going to compete with you? Where do you think the future is?
Maybe I can start on, from our point of view, of course. I mean, the point of the definition, it really matters how you approach and how you are willing to open, to innovate and to try to test. So even if, of course, we represent the traditional way of supporting lenders, being a credit bureau primary, at the same time, we are always challenge ourselves to try to understand what is next, what kind of set of data or partner we can cooperate or work on in order to improve. So I think that's the reason why we believe that also a credit bureau can be a fintech technology. Of course, the general definition is fintech is something that is disrupting the current, so has to be totally new. Honestly, I'm fine with both. The key element, I think, to your answer from our point of view is the new change is probably 20 years ago, company like CRIF were trying to do everything by itself. Meaning, of course, we develop a very strong, let's say, set of predictive data. We develop solutions and software and analytics, and that were the way of approaching and offering solutions to our clients. Today, the environment is totally different. There are so many players that are exceptional in some specific niche. And I think that today, the companies that are winning are the ones that are open to cooperate together. That's why I was really using before the terms of competition, because there are specific situations where we can be more successful if we decide to cooperate, for example, with fintech. Just an easy example, maybe we are managing big data, traditional data, and we want to help our clients going towards their branch and try to serve all the unbanked population that is working and living very remote where there are not branches. Guess what? The tool is the phone, but the phone has a big issue, that is the identification, a remote identification of a subject. There are companies that are doing a terrific job and improvement in finding how to try to solve that complex problem. That's a perfect fit for me, for example, to say, okay, we want to go there, we want to use our data, but maybe we can cooperate with someone that is working in the last 3 years solving that problem, instead of me starting from scratch, try to assess that problem. So we believe in, let's say, this kind of cooperation also with fintech, understanding exactly what might be the contribution of the different player in the complex ecosystem that is now with the client at the center. That is how we approach.
Okay. Mohan?
So, from our standpoint, maybe it's a good place to start, talk about the way we see ourselves. And to Edoardo's point, I think the bureau industry is going through a fair bit of change. I don't think anybody in that industry can afford to stay where they are. So for us, a good part of our work is in the bureau space. To that extent, we have to disrupt what is going on already. And way we describe ourselves these days is as a responsible fintech. And again, I think the emphasis on responsible and on fintech, because again, in the whole spirit of talking about the fintechs, not all of them are doing the same kind of work, but there are some that we believe are doing exceptional work. So I think there is a whole spectrum of players in the fintech space. Some who are possibly riding more on the hype, some who are actually doing some piece of work that's closer to reality and closer to actually solving a specific problem. The way we look at this is, not very differently again from the way Edoardo said this. We think, firstly, we have to think of ourselves as a fintech, as a responsible fintech, and then the next level, we have to figure out the right operating model with them. For instance, we believe that there is a strong area of collaboration that we can bring with them on data. Many of these people are actually generating a huge amount of consumer SME data, and they honestly don't know what to do with it. They are not used to handling data securely. They are not used to monetizing this data. If there's a way in which we can actually give them those capabilities that we have developed in the decades of our being a bureau, and give them those capabilities, that's a natural way of coexisting with them, and that's the first zone of collaboration that we can develop. I think the second thing that we can do together with them is harness their consumer access in a much better way. If we look at what the fintechs are able to do, I think one big thing that they have done is manage that last leg of consumer access very effectively and efficiently. If there's a way in which we can help them leverage that and build more, you talked about earlier, for instance, are playing the role of brokers. Actually, I think they've already built that bridge. Mm-hmm. So there's a way in which we can actually use that bridge for orchestrating consent, for using that consumer interaction a little more productively. I think that's something they don't know either, and they can profit from the association. I believe the third zone of collaboration is basically in taking responsible tech to them. And maybe from within their ecosystem, figuring out what we think can be responsible tech that we can take. And I believe that's again an area that a lot of fintechs are struggling with. They don't have a full stack. I mean, the average response from their side is they believe they can code everything or they can buy everything. Neither of these are realities, so they need to find that right balance between the two of these. There are things that we as mature organizations can bring into play that might help them. Equally, if they build something that's good, there is value in our trying to see if we can actually pick it up from them. So I believe that there are multiple zones of collaboration, starting from data monetization through to the consumer contact area as well as technology, that we can find collaboration models in. And I think the next few years, if we were to talk about this whole theme of alternate data, the fintechs the reality is they will have a relevant role to play. And we need to make sure that we are finding the right role for them. It's not one or the other, it's one and the other as we see it.
I like the term responsible tech. I think that's a new word, I think.
Nice.
Marc, perspective from a business information providers, but as you know them, and you've sort of highlighted that already, but, are fintechs really
You'd
there?
be a fool not to work with fintechs, right? I mean, we're looking at S&P or any one of these organizations, right? We're talking about, we're 150 years old or 180 years old or 100 years old or whatever, right? We're some 22,000 people. We're not going to move as fast as a 20, 30, 40, 50 people fintech firm. We're just not, period. They also tend to be more focused. So I think, Mohan, you mentioned that, right? They tend to go and say being focused on something very specific. So there's a firm we've been talking to, and they've got cyber footprint, and they have the ability to do all these cool things. They've never used it for risk, ever. They don't know what we're talking about. But on the other hand, they're about 50 people now. They have the ability to collect data at scale and run it really quickly. So they're a great partner because, by the way, just to your point, they also don't have this. They don't have the brand. They don't have credibility. They don't have scale. What are they going to do, right? They could go have their salespeople pitch every one of you one at a time, and it's really expensive, and it takes an enormous amount of time. Or they can work with any one of us or any one of the panelists through this event and get scale. Now, from a responsibility, we need to be honest with them, which is, by the way, we also have compliance, we have vendor risk management, we have this, we have that. So doing a deal with us is going to take a little bit of work. To some degree, if I think about the banking or the insurance space, that's actually what traditional firms can also bring to those guys, right? Like, getting a cybersecurity team, getting a compliance team, getting a regulatory team, getting approvals. Like, they're at some point when they become large enough, they're going to have to do this. Can they scale and get there a lot faster by working with one of our companies? Probably, but that by itself takes time.
It's interesting because it's almost like fintechs have the capabilities. Because fintechs sort of come in and like, well, they're fintech players in financial services, and I think it's being found out, isn't it, really, that they've got capabilities. They understand data and processing it and solving it, but they haven't got all that infrastructure that's around there, is it?
I would say there's also fintechs and there's techfin. So this is somebody who mentioned that, and another somebody I know. Like, the problem with fintechs is they start with technology and later with finance, right? I meet with a fair few of them, and the first conversation I know is never going to go very well. When I said, I got machine learning models, I got a tool, you can put your data in, it automatically spits out some numbers. Like, you actually don't know what my business is, and you're telling me you can solve whatever problem. That's not a good question. That's not a way that you can start going at it, as opposed to, hey, I fit into transaction fraud monitoring, and that's what I do. In order for me to do this, these are all the things that I do, and I can probably help you in some way, shape, or form. That's a valid conversation. So I'd say you have to start with, do they actually solve a problem? And fortunately, maybe it's just my bad luck, I meet with more that have the whiz-bang, I'm a blockchain firm, I'm a machine learning firm, and you just 3 minutes later just say, I don't really know how you can help me.
Maybe one other thing worth mentioning, Neil, is for many of these firms, I think the others said it as well, scale is an issue. And one part of what I think might be a good way of collaborating with them might also be to see if you want to make some investments in them, capital and otherwise, that can give them the financial muscle that maybe some of us as large firms already have. Is there a way you can actually co-opt them into the ecosystem and find the role for them within that ecosystem? And we think that's something that for us, for instance, is working quite well. Maybe great at small investments, giving them the mentoring to grow their organization. So it's not just the money, but also give them the ability to be able to use minds from within the organization to help grow their business and scale them. That's the other zone, maybe other way of looking at it. But I think the uniform response is yes. I can't see a world where we don't.
I'm going to ask Ben Elliott that question tomorrow when he's on the final.
But that's actually something, Mohan, I would almost say to think about working with fintechs, there's multiple ways, right? One is there's obviously that investment. One is that partnership, that development conversation. The other side to that is, each one of us can't scale either. Right? We can't be ahead of every single trend. So, like working with our corporate development team and saying, okay, these are 2 or 3 areas we really care about, and have them really be more proactive as opposed to us picking up 100 calls of everybody who wants to sell us something. So I think you have different levers to figure out what's the right approach. And I think you have to figure out from your own culture, how much are you willing to, do you have the time to spend building that partnership? Or do you want to say, what, I'm going to do, you're a round company, I'm going to do a little bit of money, and I'm going to stay with you, and I'm going to hear, and I'm going to learn what you do. And the same thing, we also have a fintech, VC fund. And we do this not because we think we're all going to get rich on the investment, but it's to really stay close to the market and understanding what are the things that are really happening, who's being successful doing what. And there's a lot to learn from that.
Totally. Good. Okay. Well, we're 23 minutes and 55 seconds and counting out to coffee break. So I'm going to open up for questions. And we've got a couple of mics roaming on each side. So just bear with us. Does anybody have a question? Yes, got one at the back there. My friend, Mr. Lithgow. And we've got one at the front here, down this side. We bring the mic down the front on the far side. Sorry, Tony.
Okay.
Please, please carry on.
This is a question to each of the panelists.
Are you on?
I'm a consumer now.
Sorry,
this is a question to each of the panelists. I'm a consumer now rather than a practitioner. And I'd like, given that there's a global antipathy towards the financial services sector and fines for malpractice are at record levels, and each of your companies are providing services to these organizations in order to try and make more money out of financially illiterate people like me. And given that the industry that you're in, the data analytics industry, is almost completely unregulated, and you're now using data that I never gave you permission to use for purposes I never gave you permission to use it for, in a 30-second elevator pitch, can each of you please explain why I should trust you?
And the next question over here, please. Thank you. We just bring him in for these questions, so no, it is a valid point. I mean, it's back to this sort of, the consumer is part of the ecosystem, and you've got to bring them with you. And I think, and sort of paraphrase Tony's question, it's just going beyond the controls of consumers. And I always say that the vast majority of consumers, if you say yes, you won't have a problem. When you start and have to say no, that you've got the problem coming. And the more and more there is going to have to be no's, because you don't give money to everybody. Mm-hmm. And I think that's where it's going to come back through the lender, back to you guys, and somebody's going to, mm-hmm. We have that in process at the moment, but we have structured data for that you can explain. If you have all this other data, how the hell are you going to explain it? Mm-hmm. What are you going to do? You're just going to end up in the courts probably. Or regulator is going to come running in and saying, oh, you shouldn't have had that data in the first place. I'm sounding like Tony Lithgow now, aren't I? But you know the question. So he always puts you on the spot, and if you don't want to answer it, I'll move to question 2. But I'll go anyway if you feel like it.
I'm free more to comment. I'm not sure if I have any real answers. Of course, we are not working blind spots, so we know that there are a lot of implications with what we do, and by the way, reputation is one of the key assets in our business. As a matter of fact, our mission in Asia is to become, in 2 years, one of the most trusted business enabler for transactions. So trust, generally speaking, but specifically in Asia, if you manage data, is the challenge. So I'm totally aware of that. But let me be maybe a little bit provocative as well. For example, if we go back 10, 20, maybe 1 year, it depends based on the specific region we're talking about. The traditional way of getting money from lenders were secure loan or providing your salary. Meaning, if you don't have information, if you don't have any reference that you can use to try to have a better, let's say, a finance option, The only option is you give me something that is a collateral, or you give me, let's say, in my, let's say, checking accounts, your salary. And if you don't have one or B, you don't have access to credit. So for me, the key point is, of course, we need to work on visibility. This morning we were talking about how artificial intelligence limitation in the concrete applications today is more linked to the so-called black box, meaning if we need to justify why we make a decision, it's very hard to do with that kind of technology. And that is to some extent slowing down some application on that technology as well. But again, what's the option? What's the option of not sharing data with the aim of providing that my reference in terms of what I represent to other lenders or with my behavior is good enough to convince you, potential lenders, to give me money because of the information that I can share. That's the way I think we should try to look at. Of course, regulator is a key component, and in the mess of everything, I'm sure that there are players that are also not managing data in the right way and based on rules. But I don't think that's a potential reason to stop understanding what kind of solutions can base in sharing data. That's really the present and the future from our point of view. Again, I don't think that I answered to the specific issue. I more provided my view of why sharing data is very important, even if, of course, there are concerns in terms of privacy and what kind of consent has been done at what time, a point in time, through this very complex integration of data.
I mean, don't worry, nobody answers Tony's question properly. That's the way they are. But Mohan, you sort of covered this a little bit earlier on with this sort of different segmentation. And I think you're probably right. In Europe, you know, you see that restriction on it to some extent because of that greater privacy. Here, I know there's this concern, isn't there? Is there a bubble happening where this data is being used and there is no tracking and transparency and consent? And I suppose you're probably right at the heart of that, aren't you?
So maybe maybe that's the part that's worth talking about, and I'll lead with what I said earlier, which is the whole theme of being a responsible fintech. I mean, Edoardo said it well when he said that when you are dealing with one of the entities here, you are clearly dealing with somebody who has reputation at stake. That's the core thing we bring out to the market, and that's going to be something that we are concerned with. Internally, for example, in Experian, we've over the last couple of years undergone a fairly big transformation in the way we are looking at business as not just a B2B business, but everything fundamentally being looked at as a B2B2C business. And we believe that the consumer at the end of that chain is going to be important. So let's just talk about this in two contexts very quickly. I think the one thing that the panel is not doing is sticking to a 30-second rule, but maybe we are trying to give you answers in our own way. The one part of what I talk about is finding the right kind of models that we think can evolve with consumer consent that can work. One reality that we all have to live with is the fact that our data is out there. Now, you're not giving any data out. It's already out there. I think that's the first line that we need to draw to ourselves. If we believe, any of us here, if we are holding a phone in our hands and we believe that our data is not out there in some form, then I think we're deluding ourselves. So that's the first line of reality that we need to walk over. Once we have that line drawn, maybe the next step to do is to think about what can we do to bring that a little more in control. I think the best part of what can be done is to try and, as consumers, equip ourselves the best way that we can. So, which is the reason, Anil, like you said, I sort of think about the world in two different ways. The US developed model equivalent for us has been models like, for example, I talked about Experian Boost before. What is Experian Boost? Effectively, it's a kind of a score where consumers consent to given data. They can sort of playlist or play with the data that they want to put in. They can playlist it and figure out what happens with it, and then figure out how to curate what information they want to give consent to being used and what information they don't want to give consent to being used. Effectively, this is in their control, and they can choose to switch it on, switch it off at whatever point they want. So that's one model that we think is evolving in the developed market context, which we believe will become a little more, sort of table stakes as we go ahead. I think in the open data context, it will become very similar. Consumers will start, putting things into a sandbox, figuring out how it will work, and then sort of let it get into production. The other way to look at this for the other part of the population is take the couple of billion people who are not financially included. A key issue for them is they don't necessarily understand as much about data or about privacy. They are worried about getting access to that credit which might give them the next meal. That doesn't mean we need to walk down that path of exploitation with that audience. I think what we need to do is set the parameters of what we think will be responsible data management for this audience. For instance, simple things that we take a view on is we don't use location data. We don't use a lat long. We use frequency of location, because that's actually as predictive and that can give you the same kind of results as lat long. Now, some of these are calls that you need to take as organizations, and we need to set some standards on them. I believe over the next couple of years, regulators will start having a role in these as well. And they'll start talking about what can be done, what cannot be done. In the meantime, I think it's left to us as responsible organizations to put that base table stakes of what we think will be the right set of standards that we want to work with, and what we will not do equally well. Walking out of, for example, opportunities is going to be equally critical for us, where we believe that they don't make certain cutoffs. So again, like I said, very long-winded answer to that question, but I don't think there are any easy answers there. And it's very different for these two parts of the world. I think it's a clear realization that we need to live with.
Yeah, and I think that, I know there's a number of regulators. We had our regulatory roundtable yesterday, and I think, it's quite clear there that, they're aware of that difference. Some easy answer is to just take regulation from the developed world and stick it in, and we all know that can have, if it's not matched to the consequence, the development of the economy at the time, the social aspects, it cannot come out well. But Marc, I know
I have the cop-out answer, which is I don't deal with consumer. Never
you
want
are
to touch
a consumer.
So our customers are large corporates, financial institutions that deal with other corporates, right? Who obviously eventually are people. I'd say one thing. The nice thing about being part of a large organization is we do have regulated businesses, and we do have a pretty, I can't use that word, a pretty tight culture around compliance. And every time we're talking about a new data set, every time we're talking about something that's a slightly different approach, the threshold to put anything into production is quite significant. And everybody has talked about, credibility, trust takes a long time to build, takes a second to lose. So I don't know that anyone particularly voluntarily wants to do this, at least from what we're talking about here. I'd say there's probably a different way to look at it. If I, again, put my consumer hat on board, I don't know, I've got children, they don't really care. They're like, yeah, I use all that stuff. Every day, I hound them. Why do you keep on clicking? Why do you keep on clicking? Well, and I just happen to have access to my kids' email accounts. I know the stuff to sign up for, and they have no idea. They don't care. I was in the train yesterday, and, it was like school was walking out. You have a bunch of, 14, 15, and, probably there were a few 20-year-olds. They don't think about it. And I think Anthony talked about it, convenience versus privacy. That's what I'm personally concerned about, is the fact that you have now a whole new part of the population that thinks completely differently from what we do.
Good, thank you. We had a question down here.
Do we have time?
Yes, of course.
Okay, I'll try to be quick, because it's going to be a rather provocative question, but I pretty much agree with all what has been said about big data, the use of big data, financial inclusion, all the things that we're trying to innovate from our sector. But the point is, all these new fintechs, for instance, are kind of niche. This niche concept is new. So what I'm trying to say is also cultural. So just as you said with your kids, there's a cultural movement that we need to be aware of. And we need to change. We'd rather change our attitude. on this new culture movement, or we are dead. So from our perspective, as business providers sector, I'd like to ask you something, a very straight question. How long it will take for alternative information as behavioral, social, environmental, recent investments, for instance, to take over and replace the traditional information that all scorings are using nowadays, including old financials, one-year-old financials? How long will it take? What do you think? I don't know if you will be bold enough to say.
No.
I don't know whether it needs to replace it, right? I mean, I think it can augment it, and I think that's the predominant view that we gave. Again, let me sort of play this in two worlds. Let's take a specific example. Let's say in India, 1.3 billion people there, about 300 million in the credit bureau, which means 300 million are credit included. We are talking about 1 billion people who are not credit included. Now, the number of people who have telco connections is close to 1 billion. When we've looked at the overlap one to the other, obviously, you have about 700 million consumers who have telco records who don't have access to credit. Is there a way in which we can actually find about another 100, 200 million consumers, the next 100 million consumers that we can bring into formal credit as a means of interpreting telco data or additional information that we can curate and build a score around? I think that's a specific use case on financial inclusion that we can bring together. And by the way, that same use case is as equally relevant in Indonesia. Again, the numbers are not very different. I mean, there's about a 30% credit inclusion here. We're finding that we can get about 30-40 million consumers that we can score and bring into the ambit of formal credit by way of picking up telco data. Now, the answer to your question is, in my opinion, in two parts. For the 300 million consumers who are already credit included in India, I think this additional information will be augmentation. For the additional 100 or 200 million consumers who are not credit included but have access to alternate data, I think it will be incremental to the base, and it will be a new base that we are creating. I don't think it's going to be one replacing the other. And by the way, as these consumers get into formal credit, they'll get into the bureaus. So, the sort of virtuous cycle starts for them in terms of their being able to get access to data. So I believe we'll head into a world where this data will augment what we have. These practices will augment what we have. I don't know whether it needs to replace it. At least I can't see a sort of near-term time frame where I believe that one needs to replace it.
I'm going to maybe take a different take on it. It's already happened, period. Depending on what you're talking about with market, it's already happened. It's already gone. Investment management use alternative data all day. That's what they do. That's how you find an edge. Even for private companies, even for, I'm talking about commercial, right? You're talking about some of the marketplace lending platforms. They already are. That's what they do, right? So I can't sit here like, oh, it's going to be 5 years until, things happen. It's like, again, if we're trying to, that's part of my jobs. I try to make people within my own firm feel very uncomfortable with it. It's already happened. Depending on which market and which region. You're going to China, there is no alternative data. Everything is on your phone. Like, every time I travel there, I can't get services because they don't know who the heck I am, because I can't get a WeChat Pay account because I don't have a Union Bank account and they know I'm not from here. So it's already there.
So take your graph, are those graphs, those dots being filled in black then, in your world?
In some cases, yes, but it's very specific to what type of firm, the size of loan, the region, right? And so the challenge is it's still very fragmented, right? You're looking at, you don't use geolocation. Investment managers love geolocation. They love to know where people are at all times and do they show up at this store and they can trade them, all that stuff. So that's already there. But it's not general, right? It's not general AI either. It's not generalized across regions, and this is where it gets very difficult. Is Indonesia is different than India, it's different than France, it's different than the United States, and just sort of having one blanket answer becomes pretty difficult. Plus then you have if I'm a corporate doing supply chain, I've got a different requirement than I'm a commercial bank in Italy, having to make a loan to an individual.
I'll tell you what I think we will agree on, the fact that this additional incremental information is something that's a core part of the business already. And if you're not using it, which is the whole point of the changing dynamics of retail risk management, if you're not already using it, I think you're losing opportunity. In consumer credit, we don't know the one bank that's actually not looking at this area or trying to find use cases. If they are not, they'd be out of the business over a period of time in any case.
If I can make a quick comment just
please.
to complement, I have a slightly different opinion. Of course, focus on the specific problem of granting loans. Of course, we can use alternative data for many other things. But if you are focused on risk management and this purpose, I don't believe that in the long term, the alternative data will replace traditional data. As a matter of fact, as CRIF, we have been working with the key stakeholder, World Bank, IFC, central banks, to develop a new credit bureau. So we are helping building the infrastructure where in specific countries where this financial infrastructure is not available. Indonesia, Madagascar, Bahamas, just to mention 3 where we are working on building the infrastructure for traditional data. Where I think that in the 80-20 rules, the alternative data can be very, very helpful is to speed up the process of building this infrastructure. So what do we do in the meantime that we help all the consumer and SMEs to get bankerized, to start working in a different way with this kind of sharing approach? And this is where alternative data can be a terrific boost using, for example, developing a social demographic scores or getting information from telco and all the other elements. So I think that, again, is the combination of 2, and the real benefit is the speed that we can gain from alternative data, but not replacing in the long term traditional data.
Good point. Thank you very much. I think I've got time for one more question. Michael, you have your microphone.
Thank you, Neil. Thank you, panelists, for this very interesting presentation and discussion. My name is Michael Ritter. I'm from the Deutsche Bundesbank, Frankfurt, Germany. And I have a question picking up on a statement Mohan made during his presentation that was saying what we are doing, this should become a standard. So some of us are sitting also in the World Bank Committee, International Committee on Credit Reporting, the standard set on credit reporting and credit risk management. So my question would be, what of your messages, methodologies, what you are doing should become a topic for this International Committee on Credit Reporting, creating visibility of what you are doing, and by this way making it a standard, creating acceptance and consequently the trust Tony Lisco is asking for. So do we have, let's say, topics, messages you would like to see as a global standard?
Well, there you go. This is your chance to influence the World Bank.
So let me have a go. I think the first part of what I'd possibly say is, we've sort of traditionally looked at banking data as the bedrock of everything that is being used for risk management. I think there needs to be a fundamental shift in that. Information is now coming in different forms. It's coming in, let's say, transactional data from telcos, from payment wallets, and so on. I don't know if the regulation is catching up enough to be able to cover the spectrum. A little while back, there was this discussion around what is financial inclusion. And basically, there was this 3-part definition. You said that the first level of financial inclusion is basically trying to get people to transact digitally. The second is basically give livelihood protection, insurance. And the third one is basically give them means of getting out of their current economic means, credit. So, it's payments followed by insurance followed by credit. But if you look at the traditional way of defining data in the bureau space, we've typically gone only with the first. Is there a means by which we can actually increase that definition of data so this question of what is alternate data doesn't exist? I mean, I've said this ad nauseum. I've said that, for example, for a good part of Asia Pacific, alternate data is data. There is no difference between the two. So if there's means by which we can get this definition broadened, I would think that's one big change in the way this can be done. The second big thing can be to see if there's means by which we can actually institutionalize the whole consent regulation and figure out what is doable and what is not doable as minimum standards at least. The benefit of the first part that I'm talking about will be the fact that you can short circuit. I mean, today, for instance, you have to go and convince a telco to give data. I think it will be a 10-year process by the time all telcos agree to put data in a consortium. By the way, this is exactly what the banks went through 50 years back or 60 years back. Can we short circuit that by getting the telcos and the other payment providers to think of this information as being publicly good and something that can be used for consumer benefit? That's, like I said, the first one. The second one is base cutoffs. What would you do? The concept of the credit bureau is institutionalized, and it was created to make sure that this information was curated by a specialized set of entities. Today, anybody who's got a server in their corner thinks that they can handle data. We need to have some cutoffs, and I'm not suggesting that it needs to be something that's the benefit of people who are in this panel. I'm just saying that there needs to be cutoffs on what are the minimum standards you will apply on who will be able to access that consumer data. I believe these will be my, maybe the top two in my wish list, if I could ask for that.
Maybe I'll try with
Big
something.
comments, gentlemen. Yeah, please.
I'll try with something maybe a little bit controversial. Get familiar with the new modeling techniques, and if you want financial inclusion, be okay with the lack of transparency, because that's the balance you have to make. And I think that's sort of the education of, the transparency from our side, what we have to provide to you, obviously. But, black box, it's not perfect. But if you can actually get financial inclusion and you have some model and there's thorough processes in place and compliance, it's different.
Live with it. Wada, you good? Okay, gentlemen, we've got a big red screen here saying time's up, as you can all see. Couldn't be even brighter, could it really? But I'd like to thank you again on behalf of the delegates for a very insightful session, and thank you for your presentations. Thank you for answering some rather intriguing questions, I would dare say. I think you handled them very well, and thank you once again. Thank you from me.
Thank you.